Everybody wants to be a millionaire, but that's one of the worst financial goals that you can set for yourself. Not because it's bad to be a millionaire, but because most people have a misconstrued conception of what being a millionaire is. I'll show you. Let's assume that you went out and you bought a home for, say, $200,000, and then a few years go by and now your home's worth $1 million. Now what? You're a millionaire. Or how about a different example? Let's assume that you put $200,000 into the stock market, you picked some great stocks, and now your stock market portfolio is worth $1 million. Now what? You're a millionaire. But just because you're a millionaire today doesn't mean you're going to stay a millionaire. In fact, there are 4 potential options of what could happen. Option number 1 is the value of your home or your investments could grow. Now you could go from being a 1 millionaire to a multi-millionaire, maybe even a decamillionaire. Option number 2 is you can sell these investments and now you can liquidate this asset, your home or your stocks, and now have cash in your hand. Option number 3 is, well, the value of these investments could fall and you no longer are a millionaire. Or option number 4 is, well, you can use debt to pull cash out of these investments. And each one of these things are going to result in completely different opportunities. Because now if the value of these investments rise, it really doesn't change much for you. Because again, this is millions on paper. You are a net worth millionaire. This is what most people are striving for when they say they want to be a millionaire. They want to be worth $1 million. But your net worth is a fleeting indicator. You could be worth $1 million today, $2 million tomorrow, $5 million the month after that, and then $200,000 the month after that, just depending on what's going on with the market, because it's just based off of somebody's perception of what your investments are worth. That paper millionaire status is just a perception. It's very different than having $1 million in your bank account, and it's very different than having $1 million asset that's paying you with consistent cash flow that you can use to live your life, but I'll get to that in just a little bit. Option number 2 is you sell this investment. Now, this is where that millionaire status becomes real, because if you bought a home for $200,000, it went up in value to $1 million, and now you sold it. Well, now you got $1 million in your pocket, assuming you pay down the home. Otherwise, you got to pay $200,000 back to the bank. But if you pay down the home, now you got $1 million in your pocket. Now you are a millionaire. And assuming that you don't have to go out and dish out a bunch of money to go out and buy another home, you have $1 million worth of buying power, where now you can use this money to go enjoy, live your life, or you can use this money to go out and buy more assets. But now it gets really interesting when we talk about number 3, which is the value of your investments fall. And this gets even more interesting when you tie that up with number 4, which is you use debt to live the millionaire lifestyle without having that realized $1 million. Because the reality of being a net worth millionaire is it's perception. It is a fleeting indicator. The value of your investments today is not what the value of your investments will be tomorrow. And the value of your investments are not what an appraiser says it's worth. It's not what somebody says it's worth. It's what somebody's willing to pay. So you might think your home is worth $1 million, $5 million, $20 million, but unless somebody's willing to write you a check worth that amount, it's not worth that amount of money. And so now you might think you're a millionaire, but then something can happen tomorrow. The economy could crash, markets could crash, you can't find a buyer, something could happen. And now all of a sudden, your millionaire status goes away. But this becomes a problem only if you're living that millionaire status. And we see this happen when you go through a boom and then an economic dip. And this is where Warren Buffett's saying, when the tide goes out, you see who's been swimming naked, becomes extremely and painfully true. Because what ends up happening to a lot of people is you make an investment. Let's say you put $200,000 of your hard-earned money into an investment. And you made great investments, whether it's real estate, whether it's a business, whether it's stocks. You made a good investment. Now this investment is worth, on paper, $1 million. Now you are a millionaire. You are a millionaire on paper. You feel rich, but you're not actually rich because you don't have any of that money in your hand, right? It's just invisible money somewhere where you know you're worth $1 million, but it's not in your pocket. But your banker calls you up and says, hey, how about you start living that millionaire lifestyle? Hey, Bunty, I know that you want to have the nice car. I know you want to have the nice things. You have that asset worth $1 million. How about we, the bank, give you this money? That way now you have the money to go out and live your lifestyle. So now you own this asset worth $1 million. And the bank says, how about we give you $800,000 worth of cash? All you got to do is pay us a little bit of interest, but no big deal. You have this growing asset. It might be worth $2 million in the future, so no big deal. Because then you can just use your appreciation to pay down the debt and you can have all the nice things as well. And it sounds great in theory and it works amazing when the economy is growing. And then what happens is you have this millionaire who starts living the millionaire lifestyle. Now you take this $800,000 of cash and you start living. You go on some nice vacations. Maybe you buy a nice car. You buy a nice watch. You buy some cool things which don't grow in value. They just lose value or they disappear because when you go on a vacation, that money's gone after you spend it. And now what happens? Well, if the economy slows down, the market slowed down, the asset market, whatever your asset is, goes down, goes from $1 million to $500,000. Well, now you owe $800,000 of debt on this $500,000 investment. You can't sell it to pay off the debt because, well, you're underwater. You'd have to bring $300,000 to the closing table to sell it, and you don't have that. You can't use the appreciation to pay down the debt because, well, you're underwater on this asset, and you don't have the money to keep making these payments because now, well, times are catching up to you. This is where being a millionaire and living a millionaire status without actually being a true wealthy person can come back to really bite you, because this is that mistake that so many people make. You make investments, you see your investments grow, and then you start living that millionaire lifestyle without actually building the wealth first. And this is where I want you to change the way you look at becoming wealthy and change the way you look at becoming a millionaire, because there's a lot more that you can do if you really want to become wealthy and live financially free. But it really just requires you to change the way that you look at money, because there's a lot of benefits to using debt. There are ways to use debt strategically. In fact, many people use debt like this as a way to limit paying taxes. Hey, don't pull cash out of the business. Don't sell your investment, because that means you're going to have to pay taxes on it. But if instead of pulling $800,000 out from profit, you just get an $800,000 loan, it's tax-free. So there's benefits to using debt, but when you don't understand the risks and if you don't know how to use it the right way, it can come back to bite you in the you know what. And this is where now I want you to change the way that you look at becoming wealthy and really work towards building true wealth, which is now having cash flow to fund your lifestyle. This is not you having $1 million in the bank, millionaire, because even if you have $1 million in the bank, the problem is if you have $1 million in the bank, two things are going to happen. Number one, every time you spend $1, your bank account is going to shrink. Your bank account is only going to get smaller unless you keep putting more money into the bank. The second thing is inflation. If inflation is 2%, which has been the historical inflation number that we've seen here in the United States, not in the past few years, but historically around 2 to 3%, that means that your $1 million that you have sitting in the bank would be losing 2 to 3% of its buying power each and every year, assuming that your $1 million is not growing. If it's sitting in a traditional savings account that's paying out 0.01% interest, that means your $1 million is using 2 to 3% of its buying power, $20,000 to $30,000 worth of value each year that your $1 million is just sitting in the bank. Now, thankfully, today, there are some high interest savings accounts that you can consider saving your money in that will pay you way more than 0.01%. Some of these I've seen are now paying upwards of 4.5%, even close to 5% interest. But if the interest rate that you're getting from your savings is lower than what the inflation amount is, the real inflation amount, not just the reported inflation amount, because reported inflation doesn't really mean anything if your cost of living is going up significantly higher than that. What that means is if the CPI data, the inflation data says inflation's 4%, but your cost of living, your groceries, your housing costs, your living costs, your car costs are rising by 8% a year, the CPI number is irrelevant because your real inflation number is significantly higher than that. So if your cost of living, your inflation is rising higher than the interest rate that your bank is paying you, well, now your savings are losing value each and every day. that's where now having $1 million in the bank is nice, because now you have a lot of buying power. You have this money in the bank, but you don't just want to keep this money in the bank forever, or don't want to plan to keep this money in the bank forever. There are strategic reasons why you want to save money, especially to buy investments. I mean, like right now, at the time we recorded this video, Warren Buffett and his firm Berkshire Hathaway are sitting on their largest cash pile ever of billions and billions of dollars, around $100 billion worth of cash. And the reason why is because they're just waiting for a good opportunity. So yes, there are times to sit on cash. There are times to have more cash than others. But you have to be strategic about it and know why you're saving that cash. If you're just saving all of your money to save it, well, you're saving your way to broke. And the reason why I'm so adamant about this is because growing up in a traditional Indian house, the traditional Indian culture is a save heavy, save first culture. The way I like to say it is, in a traditional Indian household, you make $1 to spend 20 cents. You can compare that to a traditional American culture spending, which is you make $1 to spend $2 with the help of credit cards and lines of credit. The traditional Indian culture is a save, save, save heavy culture. And so in a traditional Indian household, the way it works is you're going to work to get a good job, a good high-paying job, and then you are going to spend almost nothing. You can make $200,000 a year and live off of $50,000 a year. Why? Because now you can save $150,000. Now, you're going to live small, have a small home, have a small car, barely go on vacations, never take your kids to Disney World because you can just show them Disney World on Google. Why? That way now you can save this money. Now you might be thinking, well, there's got to be a reason why you save this money, right? Well, it depends. If you grew up in a lot of traditional Indian households, no, it's save that money to save that money. Growing up, I never saw my parents talk about investing. It was save money. Why? Because saving money is the way to building wealth. This is what a lot of people that I have seen, and some of you probably have seen as well, that if you want to become wealthy, we are taught to just save money. This is the extent of many people's financial education. Work hard, earn money, save as much of it as possible. That way you can become wealthy. Now, again, there's a time and place to save money. There's a time and place to have a big bank account. But if you're not willing to go out and invest that money, it is going to be impossible for you to ever achieve any sort of wealth. You cannot save your way to wealth, period. It does not matter how much money you save, because of two reasons. Number one, every time you spend a penny, your savings account is going to shrink. Unless you keep adding more money into it, your savings account is only going to get smaller. And number two, your savings are going to be eaten away by inflation. And this is where everybody says, well, it's risky to invest my money. What if I lose money when I invest? And that is possible. You will probably lose money when you invest. You will probably lose money at some point. Everybody does. The goal is to make way more than you lose, but you will probably lose money. But you have to compare that to saving. When you save your money, you are guaranteed to lose money. Not because your bank will guaranteed to go under, but because your savings accounts will lose value to inflation. And this is where you have to understand, if you truly want to become wealthy, you have to understand how wealth works in this economic system. So yeah, having $1 million in the bank account is great because it gives you a lot of buying power. And you might feel like, all right, now I can go live my life. I can have a bunch of nice things. And what ends up happening to a lot of people, you can just look at lottery winners to see this in action. When somebody wins the lottery, what happens? They win millions of dollars. They buy a nice home. They buy some nice cars. They go on some nice vacations. They buy some nice luxury things. Maybe they take care of their family, pay off some debts. And then 5 years later, most of them, statistically, most of them will end up broke or bankrupt because they spent all that money. And so this is where having a big bank account is good, but that is not the solution to building wealth. It's better to have a big bank account than a small bank account. It's better to have money than not have money. But if you really want to build the real wealth, you got to know what to do with that money. And the next thing that I want to talk about before I get into building that cash flow, building that passive income to really build true wealth, is now where do you put your money? Because as an entrepreneur, there's a lot of people on this channel that are building their own businesses. So I want to address that for a minute. When you're building a business, you might not have a big savings account because anytime you make money, you're putting it back into the business to grow the business, to build the business, to get more sales, to grow more profitability, to hire more employees, to build systems, to build infrastructure. In that case, the net worth of you is going to be the net worth of the business, the valuation of the business. Now, the valuation of the business, it works the exact same as when you invest in real estate, when you buy a home, when you invest in stocks. The valuation of a business is a fleeting indicator. It's really worth what someone else is willing to pay for it. If a business makes $1 million a year of profit, you might value your business at $20 million, that somebody should come in and buy your business for $20 million. Somebody else might say, I think the business is only worth $2 million. Somebody else might say that it's worth $10 million. Somebody else might say it's worth $50 million. Your business is worth what somebody else is willing to pay for it. And this is where now, if you get a big liquidation event where you build a business, you're able to build up this equity in a company. Right? Wealth is built through equity. If you've been following my channels, my videos, you know that. Wealth is built through equity. And by equity, I don't mean the equity in the home that you live in. I mean equity in assets, things like rental properties, things like stocks, things like buying other businesses, or equity in your own business. When you build up the value of your equity in your business, well, you can use debt to borrow against it. This is what Elon Musk famously did, where he didn't take a salary from companies that he was working in, things like Tesla, and so he didn't have to pay a lot of those income taxes. Instead, what he did was he received payment in stock options. It wasn't cash in his bank. He had stock equity, ownership in a company, which was worth billions of dollars, but he didn't actually own it. It was the option to have it. And so what he would do was he would go to the bank and say, hey, look, I have these stock options worth billions and billions and billions of dollars. And so what the banks would say is, okay, how about we loan you some money? Banks would have no problem loaning him millions, tens of millions, or even hundreds of millions of dollars because he's worth billions. And so now Elon could borrow money, millions of dollars, tax-free, buy whatever he wants, and use that money to pay back his interest because the value of his investment has grown so significantly. And so because of that, he got paid to live his life. Not paid, but he got the debt to live his life. He didn't have to pay any taxes. Now, of course, that comes with a lot of risk because if the value of his investment goes down, he still has to pay back all of that debt. But this is where now understanding, if you're going to value that idea of being a millionaire, you have to understand what it really means to be a millionaire, and you have to understand what it really means to build that wealth. But if you do have a big liquidation event where now you build a business and you're able to sell it, meaning you work to build this business, you built this equity in your business over years or decades, and now you sell it, and now you have millions of dollars in your bank account. Again, you might feel rich, and you are, because you have a lot of money in your bank. But if you start living that multi-million-dollar lifestyle, you have $50 million in the bank, that is a lot of money. Many people will never need another paycheck again. But what ends up happening to most people who receive or get a lot of money is now it's time to celebrate. And now you need to live that deca-millionaire lifestyle. So now you got to get a mansion to match. You got to have the cars to match. You got to start flying on private jets to match. If you cannot create any more income out of that cash, your cash balance is going to reduce. It's going to get smaller every time you swipe your credit card. And you were on a trajectory to zero. And this is where now understanding what does it mean to truly be wealthy. It's not being a millionaire. It's not having a net worth of a millionaire. It's not really having any sort of net worth level. It's having true freedom. When I was sitting with Robert Kiyosaki, the author of Rich Dad Poor Dad, I really liked one of the things that he said, which is wealth is measured in time. Richness is measured in what you can buy. If you have $1 million and your expenses, your cost of living is $100,000 a year, you are rich for 10 years. But after those 10 years, you're no longer rich because you had $1 million, you spend $100,000 a year. After 10 years, you got no more money left. Now you got to go back to work to earn more money. So yeah, you were rich for 10 years, but that's not true wealth. If you really want to be wealthy, this is a measure of time. How much freedom can you really have and for how long? So now let's flip it up. you have the expenses, $100,000 a year of expenses. And now instead of having $1 million in the bank, you own an investment, or you own a business, or you own some rental properties that pay you $100,000 a year of cash flow. Now you're wealthy for infinity because you have $100,000 worth of expenses, you have $100,000 worth of cash flow from your investments. It's a completely different game, and now you have built true wealth because now you can spend $100,000 this year, spend all of your money, be broke, and then get another cash flow check next year. That's the true definition of wealth, where now you can start living your life, not have to worry about money, and continue to keep getting paid. And it doesn't mean you have to necessarily change everything that you do. It's changing how you're using your money, and it's changing the way that you look at wealth. And this was something that I learned just through doing. Because when I started my entrepreneurial journey, I started off hosting parties. I was an event planner, hosting parties when I was in college. And what I learned and what I saw was if I didn't host a party, I wasn't getting paid. I was making good money. I thought I was starting a real business. I thought I had some great investments doing this, investing my money into myself. But if I wasn't hosting something, I wasn't getting paid. But then I took some of the money that I was earning and went out and I bought my first rental property. Now, I'm not going to say it was all sunshine and rainbows because I made every mistake you can possibly imagine. It was a huge time suck out of me. I started reading books about real estate investing, and it said, oh, all you got to do is hand the keys over to a property manager, and it's going to be so easy, so passive, and all this stuff. That's a bunch of crap. When I was getting started, I made every mistake possible. My property manager sucked. My contractor screwed me over. My tenants were nightmares. But I learned a lot. And what I saw through all that crap was I bought this thing. I bought this rental property, and now after all of my expenses, because I had to pay things like the HOA fee, my property taxes, my insurance, my maintenance fees, my management fees, and everything in between. After all of my expenses, this property was still paying me $250 to $350 a month. Now, this didn't value my time because it was a huge time suck in the beginning, but I also understood that there are some real estate investors out there that own thousands of units, tens of thousands of units. There's no way that they can manage each individual one. All I had to do was figure out what the heck I'm doing wrong here and then be able to scale that. It was a very painful thing, but I knew that it was possible. I just had to figure out how to do it. So now, if I can own one unit and it's going to pay me, say, an average of $300 a month, that means I got to figure out how can I go out and attract 10 units. If I can have 10 units and each unit is paying me $300 a month, that's $3,000 a month of passive cash flow. Now, I don't like to call it passive income. I like to call it cash flow because the idea of passive income that you never have to do anything is a little bit misleading, because even with real estate, my rental portfolio today is passive, but I had to work really hard to make it passive. And I still have to manage my management companies because I have multiple property managers that are looking over my rental properties. I got to manage them. I look over my profit and loss statements. I meet with my property managers to make sure that everything is going well. So yeah, I'm not actually working at the properties, but it's not completely passive. I'm still putting in the work to make sure I keep getting paid and that my properties are still paying me the types of returns that I'm looking for. And if I need to make a change, if I need to fire a property manager, if I need to sell a property, move things, I'm still involved in these decisions. But the cash flow is still coming in. And so now, one property, $300 a month. If I can get 10 properties, that's $3,000 a month. If I can work to get 100 properties, that's $30,000 a month of cash flow. Now you can see how my mind started to spin. What do I need to do not to start stacking this cash flow? Because everybody says it takes money to make money, and that is a complete lie. You don't need money to make money. You need money to grow money. This is that difference in thinking and mindset that most people never understand. We always say it takes money to make money because, oh, you need money to go out and buy rental properties. And you do. You're right. It takes money to go out and buy investments. It takes money to go out and buy assets. But it doesn't take money to you to go out and get that money. It doesn't take money for you to go out and get a job. It doesn't take money for you to go out and start a business. Now, I get it. You need money for clothes. You need money for some of the basic skills. You need money for food, your basic living necessities. But you don't need tens of thousands of dollars to start a business. You can start a business with under $1,000. You can go out and get a job. If you have basic clothes and you have access to a computer and a library, you can start producing an income. You don't need tens of thousands of dollars or even thousands of dollars to do this. But it takes a lot of hustle, it takes a lot of skill, and now you're working to learn, you're working to grow, you're working to earn money. And once you start earning money, then you can use this money to grow. You can use this money to create the cash flow. You can use this money to create more outside income, because now you're taking the money that you earned and you're not using your money to go out and buy a car. You're not using that money to go out and buy a big home. You're not using this money to go out and go on a vacation. You're using this money to buy assets. And now what type of assets are you buying? And this is where now you can buy assets with the goal of trying to grow them. You're buying a stock for $100 to hope that you can sell it for $200, or you're buying a stock for $100 that's going to pay you with cash flow each and every year. There are two different ways of looking at money. For me, I like the game of cash flow. It makes sense to me because when I got started and I started investing in real estate, I started experiencing this cash flow. And it sounds cool in theory, but it's a whole different thing when you see it in your bank account, because it was something I had never, ever been exposed to in my life before. And that was one of the most shocking and emotional, angry things in my life. I had studied my butt off in school. I did everything right. I had checked all the boxes, but I never once learned to think about creating cash flow. We go to school, study hard in school to get a good job so we can make money, so we can be financially free, or at least that's what I thought. But I think that's what most people think, is that we're working hard in school so we can be financially free, right? But there's a big disconnect there between how your job is going to help you be financially free. That disconnect is what most of us are never taught, unless you're born with rich and wealthy parents who know financial education, who understand investing. Most of us are not taught that. And so now either you're going to figure it out yourself, or you're going to live a life of confusion and misery and not understanding why you never became financially free. But you can create cash flow. It's not easy. It is going to take money. It's going to take hard work, and it's going to take learning. But now if you're working to earn, what do you do with these earnings? And the traditional way of, you're just going to take this money and put it into the markets, put it into 401k, and hopefully this thing grows. It's not bad. That's not a bad way to do it at all. Okay, make sure you hear me out on that. I am not against that. But for me, the way my brain works, I like cash flow, because cash flow means I keep getting paid month after month after month, quarter after quarter after quarter, year after year after year. And when you see things like inflation happen, guess what? Your cash flow also generally goes up. Now, are there times where cash flows can go down? Absolutely. If you go through a recession, guess what? Rents get cut. Dividends get cut. Cash flows get cut. But you can get more cash flow when you see things growing as well. And so this is where now you got to understand, what type of game do you want to play? We already know that if you want to become wealthy, it's not through saving. It's not by buying the nicest cars. It's by taking the money and investing it. I'm not going over how do you do that in this video. I got tons of other videos on my channel that you can watch if you want to learn how to do that. If you want to build wealth, you have to take this money and you got to put it to work. Now, you can put this money to work in an investment that's going to hopefully appreciate, or you can put this money into something that's going to produce cash flow. When you put it into something that will hopefully appreciate, you got some benefits. The benefit is, if it goes up in price, you don't pay taxes until you sell. The other benefit is, if you put your money into a stock, and that stock is not paying out a dividend, it's not paying out any cash flow, that means that the company that you invested in can take all the money that they made and reinvest it back into the company to grow their revenues, to grow their profits, to grow their stock price. So the company will be working even more aggressively to increase the value of their investment. So when you're investing for appreciation, there are some benefits there. But the con is you're speculating. There's no guarantee that the investment you made is going to go up. This is a big thing that you see in real estate, and where me and a lot of real estate investors disagree. There's a lot of real estate investors out there that will invest in very low cash flow producing properties, where you have to invest a ton of money and make next to no money or lose money every single month in order to keep owning the property. And the reasoning is, well, I buy this property for $1 million today. I'm not going to make any money for 2 or 3 years, but in 3 years, I'm going to be able to sell this property for $2 million. And that $1 million of profit will more than pay for the 3 years of no money or losses that I made. Now, for some people, that's fine. For me, I don't want to do that because there's too much risk. What happens if the property doesn't grow to $2 million? What happens if the property falls in value? Now I'm stuck with a property that's not paying me or that I have to pay every single month to own. I don't want to do that. Instead, I want to buy a property for $1 million. And instead of maybe seeing that $2 million valuation in 3 years, I'd rather just get that $70,000 worth of profit each and every year. That's a different way of looking at the game. It's a different way of looking at the properties where I want the cash flow, because the cash flow for me is much easier to predict. It's much easier to calculate. And it's cash today that I get without having to sell my investments. It's a different way of looking at it, and I like that cash flow because now when I make my investments, the bulk of my investment portfolio are cash flow producing assets. And you're thinking, but Jaspreet, I don't got $1 million. I don't got $100,000. Don't worry, I'm going to talk about some alternatives in just a second as well. But if you want to create an income stream where now you own these assets that are going to just pay you and keep paying you without you having to now go to work to do this thing, it's going to require you to just change the way that you're allocating your money. Now, of course, I'm not a licensed financial advisor. If you have specific questions, talk to a licensed financial advisor in your area. But this is where now just understanding what your options are is so important. Now, what if you're saying, Jaspreet, I don't want to invest in real estate, or I don't know how to invest in real estate, or I don't have the money to invest in real estate. I don't have tens of thousands or hundreds of thousands or millions of dollars to go out and invest. That's okay. Most people don't. Now, if you want to be a real estate investor, it will take money, but it also takes that dedication, right? Like anybody can be a real estate investor, no matter how much money you're making, but you have to devote yourself, make that a goal, and do whatever it takes to go out and start investing in real estate. That means start looking at prices of properties, seeing how much of a down payment that you're going to need, working to accumulate that down payment, trying to find some creative financing, working to make that happen. But if you don't want to go that route, or if you want to start investing with much smaller amounts of money, there are ways for you to generate cash flow from the stock market. And now through the stock market, you can still generate cash flow through dividends. Dividends are when a company pays you cash flow just for owning the company. And the way it works is the company will pay out a dividend if they have big enough profits. And now they can take this cash and just distribute it to their owners, their shareholders, people like you, people who own their stock. So not every company pays a dividend. And the companies that pay a dividend are generally going to be more mature, highly profitable companies that don't have a better use for this money. Because if a company could have used that cash in their bank to invest back into the company, to grow their revenues, to grow their profits, that might have been a better decision. But what they're saying is, we don't want to save this cash. We don't want to invest this cash back into the company. Instead, we just want to give it away to the shareholders for owning the company. So there's pros and cons to getting that dividend. And another con to the dividend is when you get paid, you also got to pay taxes on that dividend income. Now, if it is a qualified dividend, you're also going to get more tax breaks. You're going to have lower tax rates on that dividend. But there's no limit to how much dividend income that you get, and the amount of work required to get that dividend income is generally a whole lot less than the amount of work required to go out and start investing in real estate. So there's a lot of benefits to investing in dividend paying stocks. If you want cash flow, you just have to understand the risks, the pros and cons of that versus somewhere else. I invest my money into real estate that pays me cash flow. I also invest my money into dividend paying stocks or dividend paying ETFs, funds that pay me with cash flow. Now, I'm going to tell you how I do it, and I'll explain different ways that you can invest your money. Again, I'm just telling you this as an example. I'm not telling you what to do. I have a passive investment strategy where every week, for me, it's Wednesdays. There's no magic sauce as to why it's Wednesday. I just pick Wednesday because it's in the middle of the week. I used to do it on Mondays and Fridays, but when you have government holidays and the stock market's closed, sometimes you miss the opportunity to invest that week. So when it's Wednesday in the middle of the week, there's a higher chance that I'm not going to have weeks where money isn't invested. So I invest my money every Wednesday. It goes into the stock market, but it goes into a portfolio of ETFs that I have. ETFs are funds that invest into a basket of stocks. Like if you were to go out and invest into the Amazon Corporation, you are investing in Amazon. And now if Amazon goes bankrupt, you lose all of your money. The entire investment goes down to zero. and you are taking on all the risk. If Amazon were to take over the world, well, you get all the benefit. So when you invest in one individual company, higher risk, higher potential return. When you invest in an ETF, now you can invest in a fund that's giving you exposure to a broader amount of companies. Like I can invest in a fund that gives me exposure to the Amazon company and 499 other companies. Now, if Amazon were to take over the world, that would benefit my ETF, but it would also be balanced out by some of the losers. Likewise, if Amazon went bankrupt, that would hurt my ETF, but it'd be balanced out by some of the winners. So ETFs allow you to now protect your investments. And I have a portfolio of ETFs that I invest in. And I invest in 4 different categories, 4 different types of ETFs. I invest in, number 1, my largest, are dividend-paying ETFs. Number 2 are value ETFs. Most of these also pay dividends as well. Number 3 are innovation ETFs. And number 4 are emerging market or international ETFs. So ETFs that invest in companies and countries in overseas. In my dividend ETF portfolio, what's happening is now when the money goes there, I am buying ETFs for the purpose of generating cash flow. So every Wednesday, I'm buying more cash flow producing assets, period. And then when these ETFs pay me with a dividend, which I get generally every quarter, meaning every 3 months. These dividends pay out a dividend every 3 months. I'm not taking the money and I'm going out buying a fancy car with it. I'm taking the money and I'm buying more cash flow. So it becomes a machine. Every Wednesday, I'm buying more cash flow. When my cash flow producing assets pay me with cash flow, I take that cash flow to buy more cash flow producing assets because I don't need the cash right now. I'm just working to build. This is my building time where now I am taking my money, I'm working hard to earn. I have my businesses, I work hard to earn money. Now, when I earn this money, I'm not taking this money to go out and buy fancy cars and do a bunch of fancy, expensive things with it. I'm earning this money to buy assets. One of these assets is in the stock market, and one of the types of assets that I buy in the stock market are cash flow dividend producing assets. These assets are now working to produce me cash flow, and that cash flow is also buying me more cash flow. Now you might be asking, well, what are some examples of dividend ETFs that I can consider buying? Well, US News put out this article on what they call the 7 best dividend paying ETFs that you can consider buying. Here are the 7 ETFs that they recommend, and again, investing has risks. Make sure you always do your own due diligence and never blindly follow a random guy on YouTube. Number 1, SCHD, which is paying out 3.6% a year in dividends. VYM, paying out 3% a year in dividends. HDV, paying out 3.8% in dividends. VYMI, paying out 4.4% in dividends. SPHD, paying out 4% in dividends. LVHI, paying out 7.3% a year in dividends. SPYD, paying out 4.5% in dividends. Now, as a disclaimer, every one of these with an asterisk, the first 4 that I mentioned, are dividend-paying ETFs that I am personally invested in. Again, do your own due diligence. So now, what does this mean? You can build systems where every week, every month, every 2 weeks, you have cash that leaves your bank account and it can be invested into a portfolio of ETFs. It doesn't have to be these dividend-paying ETFs. It doesn't even have to be dividend-paying ETFs, but you can pick some investments that you want to own. And now every time you get paid, a piece of your money is automatically going to be invested. And the way that you win in this game, especially in the cash flow game, is you stay consistent and you do it for the long term. Because now when you hear that a investment in ETF is paying out 4% a year in dividends, it's not a lot of money. Because now if you invest $100, that's $4 a year in cash flow. But if you invest $100 a week, every week for 10 years, now that starts to add up, especially when every time you buy, you're getting $4 of cash flow, and then you use the cash flow that you're getting to buy more cash flow. If you stick with it and you stay consistent and you keep reinvesting your profits, well, in 10 years, you're going to surprise yourself. And you might be thinking, but Jaspreet, I don't want to wait 10 years before I can start using this cash flow. I want to have it today. Well, 2 things. Number 1, building wealth is not an overnight game. And when you try to make it an overnight game, well, you end up losing a lot of money to people selling you a whole bunch of get-rich-quick services. So I want you to understand that. And number two, you can amplify and shorten the amount of time it takes for you to become wealthy. That's going to require you to earn more money. Now, how do you earn more money? Well, you can earn more money from a job, or you can earn more money from building your own business. If you can build your own business, there's no limit to how much money you can earn if you can sell more stuff. But again, it comes back to now, wealth is built through owning investments. It's through owning assets. What type of assets do you want to own? Do you want to own assets that will hopefully grow in value, or do you want to own assets that will pay you with cash flow? If they pay you with cash flow, it's a much more slower producing game. That's just the way that it works. When you invest in real estate for cash flow, you're not going to get a 50% cash and cash return on your money, or you're probably not going to. So you're going to get a slower return. Like for me, what I would consider a good return, when I go out and invest in real estate, I'm looking for a 7% cash on cash return. So when I invest $100, I want $7 of cash flow after my expenses. If I invest $100,000, I want $7,000 a year of cash flow after my expenses. So it's a very slow game. But if you can have more money and you keep taking this more money and you keep using this more money to go out and buy more of these cash flow producing things, if you stick with it, well, you're going to keep amplifying and growing the amount of cash flow. So you got to understand the game. First, you got to get the money. I'm not talking about how do you get that money today. There's a lot of ways you can get the money. You can do it from your own business. You can do it from your job. You can do it however you want. You got to get the money. And it doesn't take a special degree, a special way you look, a special anything to get that money. But it does take the hustle. It takes the risk tolerance. It takes the ability to learn. And it takes the ability to fail. If you have these things, you can go out and get the money. Once you get the money, the question is, what do you do with the money? You can spend all that money and be broke tomorrow. You can save all that money and be broke at some point in the future, or you can invest this money and work to build a future wealth. Now, when you invest this money, you can either be an appreciation investor, a cash flow investor, or a hybrid of both. I'm a hybrid of both, but I prefer cash flow, generally. When you invest for appreciation, you're speculating. There's no guarantee that something's going to ever pay you in the future, but if it grows, you can see a lot of returns, and you can also get some tax benefits because you don't actually pay any taxes until you ultimately sell. When you get cash flow, you get a little bit more of a guaranteed payment, but it's much slower. So now, when you're working to invest in cash flow, that's when you can decide how do you want to generate that cash flow. And right now, I've been focusing on real estate and stocks. There's a third way that you can generate cash flow, which I want to highlight in just a minute. But now you can start investing in real estate and stocks. Real estate is going to take you more money to get started. Real estate has bigger and better tax benefits, but it's more involved. You got to spend more time, you got to spend more effort, and it's going to take more capital to get started. In stocks, it's much more passive to generate cash flow from stocks. Much less work and much less money required to start generating cash flow from stocks, and much less maintenance and oversight to do that. Anybody can start doing it with as little as $100. But the key with no matter what you do is you got to stay consistent. This is not something where you work to save money, you invest it once, and now you have enough cash flow to live your life. Or at least for 99.9% of people, that's not how it's going to work. But you have to now work to accumulate this money. That way you can go out and start buying these assets. And then that's where you can make the decision. Do you want the cash flow or do you want the net worth? I like the cash flow. That's the way that my brain works, because now I can just work to stack the cash flow. And this is where now I know how big I can live. I can live as big as my cash flow, because when my cash flow is growing, I can go out and spend more money, because now I know that if I spend all my money today, I'm going to get more cash flow checks next month. Now, this brings me to the third way that you can start generating the cash flow, which is the most difficult way to do it. And that's why I saved it for here, because when I talk about this, everyone's going to say, oh, but Jaspreet, not everybody can do that, and it's very difficult. Well, there is a third way. And this is going to be reserved for entrepreneurs, people who really want to build a business. The third way that you can generate cash flow is you can work to build or buy a business that you don't have to work in. And the way that it works now is you get paid the profit, but not a salary. And if you are able to build a business where you can pull yourself out of, meaning you can hire a CEO to run the company, now the business can run as normal. The CEO will hopefully, if you structure it correctly, be incentivized to grow the revenue and grow the profits if they're getting a salary and either ownership or a piece of the profits. They'll be incentivized to do this. Now, your business is a machine that's working to produce more money. And where does that money go? The money doesn't go to the CEO. The money doesn't go to the employees, although they are the first to get paid. The money goes to the owner or the owners. And in this case, that's you. And so this is where you have to understand a little bit of corporate governance to really understand the way that this works. When you go out and start a company, the first person that's going to get paid, assuming you don't have any debt and all that other stuff, is going to be the employees. It's probably not even going to be the CEO, because now you have to make sure that your employees get paid, because if you started a company and you're the CEO, well, if your employees are not getting paid, they're going to leave way before you do. So you got to make sure the employees get paid. You got to make enough money to pay the employees. Then when you have enough money coming in to pay the employees that you can take out a salary too, now you're working to make money for the employees and to pay your salary. Then if the business can continue to grow, the business is going to start making a profit. And this is where now obviously you can do a few things with that profit. You can take that profit and save it. That way your business can build a big savings account for a rainy day. Your business can take this profit and reinvest it back into the company. That way they can grow bigger. Or this business can make a profit and you as the owner can take this profit money out and go out and buy a nice car or do whatever it is that you want with it. And if you can continue to grow to a business that doesn't require you, now you can go out and hire a CEO. Pay them a fair CEO salary, which is going to be a lot, and incentivize them to continue building and growing the company. Now, this is a lot easier said than done, but if you are able to build a business that does this, now you have a cash flow producing business, because once you step away, the CEO is now in charge. You have fired yourself, brought in a new CEO, you still own the business, you own the equity. Well, who gets paid first? The employees get paid, the CEO gets paid, the equity owners get paid last. Because now as the equity owner, you get paid with profit. And you are the last person to get paid. And this isn't just me saying this. This is legally the last person to get paid. Because if your business goes into bankruptcy, the equity owners, the shareholders, the investors are the last people to make a penny. And most of the time, you're not going to make any money if your business goes into bankruptcy. So now, when you are the owner, if you can build a business, the employees get paid, the contracts get paid, the bets and the debts get paid. But if there's money left in the bank account, that profit, that is your cash flow that now you can use to live your life. It is not easy to do this, but it is possible. And it's another way for you to generate cash flow. So you can generate cash flow from businesses. You can do this by building a business. You can do this by buying another business, but that's going to take even more money, because if you want to buy a business this big that's producing enough cash flow that it doesn't need you, it's going to cost a lot more, likely $5 million and up, if not more. But it's going to be a multi-million-dollar purchase for you to go out and buy a business that doesn't need you. You can go out and buy real estate, or you can go out and start investing in stocks. And so now, depending on how much money you have access to, it's just where do you get started. Now, if you want to do more, you got to earn more. And that's a whole different skill set of how do you earn more money. There's a bunch of videos on YouTube that will go over how you can start attracting more money. And then the question is, what do you do with this more money? And the biggest mistake that 99% of people make, 99.9% of people make, is as soon as they start making more money, they start living a bigger lifestyle. But if you really, really, really want to become wealthy, you got to understand, why are you working to earn more money? You got to work to earn more money to buy more assets. And in this game, in this video, it's buy more cash flow. You're working to earn more money to buy more cash flow producing assets, because now this cash flow will determine how big you will live. You want to buy a nice car? You want to go on nice vacations? Great, no problem. Just make sure your assets can pay for it for you. If you want to be a successful investor, there are 10 mindset traits that every successful investor has that I'm going to go over in this video. And number one, if you want to be a successful investor, being avoiding the shiny object syndrome. Now, when I say shiny object syndrome, I don't mean now you take your money and you go out and buy fancy cars and nice things because that's the attractive thing to do. I'm talking about the attractive investments, because now when you have $5,000, $10,000 put aside, you can go out and invest at the slow and steady place, which is more likely to give you a long-term return, and you know that, but you see that nice meme stock, or you hear of that new cryptocurrency that's about to blow up, or hear this new investment opportunity that nobody knows about, that is on the verge, the cutting edge of being able to 10x your money almost overnight, about a year. So it's not a get-rich-quick scheme. It's like a 12-month game plan, but you can take your $5,000 and turn it into 50 grand by this time next year. I mean, you have to work a whole 12 months to earn that much money. You can just put this money in, double how much money you're making by putting this money into this, not a get-rich-quick investment, but a get-rich-almost-quick investment. But what ends up happening to most people who start chasing these types of shiny investments are, well, you end up paying the price. And they go through these bubbles where the early people who get into these types of amazing opportunities, you might be able to get in, be a testimonial, and get out quickly. But it's almost like a drug where when you start to make that money, you don't want to get out. And so now you want to go in even deeper. You make some money and then you put it all back in there, maybe even more. And you start telling your friends about how much money you're making. And then that's when they come in, and it keeps growing until ultimately this investment, which was poised to make everybody so rich, starts to implode because it didn't have any real value to begin with. There is a lot of value in being a long-term investor. It's not the most attractive thing to do, but there's a reason why over the long term, the successful investors are not the ones that see this overnight success. It's the ones that have worked to build a long-term sustainable portfolio. They say the faster it comes, the faster it goes, because, well, if you don't have to go through the work and pain to earn it, you're not going to know how to keep it either. The second thing every successful investor does is they invest in their mind. And this is where I want you to understand the difference between the price you paid, the cost, and the value that you receive. And there's a lot of different examples of this, of price versus cost. But this is where now you have to understand what is valuable to you. And I remember this example because when I was getting started in real estate, I got my real estate salesperson's license. I began working for a company called Keller Williams. And then the broker that I was working with told me that she was hosting this seminar on real estate investing. And because I was in her office, she was going to give me a free ticket. I said, okay, cool. I go there and somebody was pitching a class. It was $3,500, I believe, on how to wholesale real estate. I had no idea what wholesaling real estate was. It seemed like a super attractive thing, especially for me getting started in real estate and trying to understand the whole game. And so that was a lot of money for me then. I mean, it's still a lot of money today, but it was a lot of money for me then. But I went out and I spent that $3,500. Now, this is where I know a lot of people, because I talked to a lot of people about this back then, got hung up on the $3,500. Why would I want to spend $3,500 on this class? Education should be free. That's way too much money. It's just making them rich, right? We're focused on the price. We're focused on the cost as opposed to what's the value that I'm going to get. Well, I spent that money on the class and I knew that I wanted to do something with it, and I went through it. And well, after month 1, I didn't make my money back. I made no money. After month 2, I didn't make any money back. I actually still hadn't made any money. Month 3, that was when I also didn't make any money. But then in month 4, I also made $0 from that class. It wasn't until month 5 that I actually made any money from this program. And in month 5, I made, I think it was about $10,000 off of my first sale, which more than paid for the $3,500 that I had to spend. Now, it took a lot of work and effort on my part, but I had to spend money in order to get it. The value to me was way more than the cost that I had to pay. And then I also closed a lot of deals after that. But it took me an investment on my part. Now, I'm not saying go out and just throw your money around and just buy any class, every program, every coaching thing out there, no matter how much the price is. But you have to now look at the value that you receive. If you buy based off of value as opposed to price, it's a completely different way of analyzing things. I see this in almost anything. When I go to somewhere far, if I got to go to Europe, if I got to go to India, growing up, I used to go to India pretty often. And I used to have to sit in the back economy, sit like a sardine, and flying to India from the United States is like a 20-hour journey. When you sit in economy, it is very uncomfortable. You can't sleep in those 20 hours because there's somebody to your left, somebody to your right, somebody's always rolling over, the lights are always turning on, somebody's always annoying you. There's just a bunch of things happening, and you got to sit like this. It's not comfortable. It sucks. But then if you want to go to business class, you're going to pay 3 to 6, maybe 7 times more money to have a room, essentially this area where you can have a reclining seat, you can lay down, the food is nicer, the service is nicer, it's way more peaceful, it's way more comfortable, and you can sleep comfortably. Now, again, both economy and business class are going to take you to where you got to go. One's just a whole lot more comfortable, and that value of that comfort is valuable to me, which is why I am willing and I do pay for that added price. Now, I don't always buy first class tickets. If I'm going on a short domestic flight, yeah, you bet I'm going to sit in the back if it's cheaper. But if that value is worthwhile to me, I will pay for it depending on what it is. And this is where you have to figure out what value is important to you. I have spent a lot of money on education, a ton of money on financial education and business consultants. Some of it paid off, some of it didn't. That's kind of the way life works. And this is where now you got to figure out what is valuable to you. And if something is valuable to you, be willing to spend money on that. For me, if I'm flying long distances, business class tickets are valuable to me. For me, business education is valuable to me, so I pay money for that. Sometimes it works, sometimes it didn't. I had spent over $100,000 on consultants for a blog that I was working to build. And that's just the consulting fee. I also spent probably, I don't know how much, but at least another 6 figures on writers and editors and softwares and all this other stuff to build this blog. And guess what? It was a complete flop. I lost everything in that investment. So sometimes it works, sometimes it doesn't. And this is where now understanding, okay, what is valuable to you? Be willing to spend money on things that are valuable to you, but also make sure that you have the ability to spend on it, right? But just because financial education is valuable to you doesn't mean that you should go into credit card debt to buy expensive programs if you're never going to do anything with it. So you got to be honest with yourself, but look at what's valuable, find the value, and if the value exceeds the price that you have to pay, this might be something you want to consider buying. Number 3 is you got to be a long-term investor. And this is one of those things that is so difficult for people, especially who are getting started with investing, to wrap their heads around, is because they think, I'm going to put my money into this thing today, and I'm going to monitor the heck out of my stock market portfolio every single day. That way, hopefully, I'm going to be able to make a lot of money. But if you really want to build wealth, it's not going to happen overnight. It's not going to happen in 6 months. It's not even going to happen in 6 years. It is a long-term game. And this is where you got to just stay consistent. And this is one of those things where building wealth is a marathon, it's not a sprint. And you can amplify how fast you can become wealthy. But the way you amplify it is by putting more fuel in the fire, meaning earning more money and putting more money into your investments. If you can work to earn more money, well, now you can go out and buy more investments and build that wealth much sooner, build the cash flow much sooner, build the investment portfolio much sooner. But you have to be understanding that it takes time to build these investments. It is not something that happens in 6 months or even 6 years. This is a long-term game if you really want to get the rewards of being an investor. Number 4 is you ignore the traditional media. Look, I'm going to be a little bit honest here because I work in the media space, and most traditional media is in the business of selling hype and emotion. It's like TMZ. Why is TMZ so popular? All they do is try to get people angry or get people's emotions and doing a bunch of crazy things. People love watching people's emotions. You're attracted to that. Now, when you go into other news, like the financial news, it's a more sophisticated version of that. People love the drama. That's what draws the clicks. And I'm going to tell you very honestly here, YouTube works the same way. YouTube works on emotion. That's why you see a lot of titles and thumbnails that have to be a little bit clickbaity, because if they're not, I'm going to be honest with you, it's going to end up in the YouTube graveyard. It sucks, but that's the way that it works. Now, that's one of the reasons I also have been working so hard to build Market Briefs, which is my daily financial newsletter, because it allows me and my team to distribute the financial news without the sensationalism, without the clickbaitiness, because all the news is in one email. And so now we don't have to go out and put out this clickbaity stuff, because once you open the email, everything is there and we can provide all the unbiased information without all the emotion. But the reason why I'm saying this is, now if you are working to understand what's going on in the financial markets, it's very easy to be drawn in with the emotions. And if you make decisions based off of headlines, it's going to be a very emotional roller coaster and a financial roller coaster for you. That means when you are investing your money, you got to cut out the emotion and look for the real opportunity. Because most of the time, things are never as good as the media makes it seem, and things are never as bad as the media makes it seem. It's somewhere in the middle, and it's your job to figure out where that is. Now, if you want to actually figure that out, this is where you want to be digging into the raw data, reading unbiased news sources, and creating your own education yourself. That's my goal with Market Briefs. It's a free financial newsletter that you can read. It's a simple email that you can read in less than 5 minutes every morning. And if you want to join Market Briefs, I got the link to how you can join down in the description below. Number 5 is you got to value your time. This one was very difficult for me because growing up, I was kind of cheap and I never really wanted to spend money on anything. And until I started valuing my time, it was very difficult for me to spend my money on certain things. And I'll give you an example. When I started investing in real estate, I knew I didn't want to be involved in managing my properties because the books that I read talked about in order to scale real estate, you need a team of people. That way you are not a property manager, you are a property investor. And that was the first time I really made that decision to value my time, because I knew my goal was to own a real estate portfolio. And I already knew that there was no way that I could drive out to each house and talk to every tenant and do everything. It just seemed like way too much work because I was also in school when I started investing in real estate. So I went out and I hired a property manager. Now, when you're just starting off in real estate, you don't have a lot of negotiating power with a property manager. So you're going to pay close to 10% of your gross rental income to your property manager. If you rent out a property for $600, that's $60 a month. If you're renting it out for $1,000, that's $100 a month. If you're renting it out for $2,000 a month, that's $200 a month in management fees, which it's a pretty big chunk of your revenue right off of the top. But I knew that my time, that was the first time I valued my time, and I knew that my time was worth more than that, because if I got sucked into the game of just managing tenants, there was no way that I was going to be able to earn money anywhere else. And this is a big thing that I see with other, especially newer real estate investors, but it's not just new ones. You see experienced real estate investors with 30 units doing the exact same thing, where it's the same argument. I don't want to have to pay another person to do what I can do myself. And sure, you can manage your properties yourself. You can do a lot of things yourself, but there's only 24 hours in a day. And what do you want to spend your time doing? You're paying somebody to free your time up. You could do the same thing with having somebody go out and get your groceries, having somebody cook your meals for you, having somebody wash your clothes for you, clean your house for you, mow your lawn for you. There's a lot of different ways that you can buy your time back. And if the price you have to pay is lower than what your time is worth, then it's going to be beneficial for you now to pay somebody to do something instead of you. Now, there is a balance to this, because especially if you're an entrepreneur, you're trying to build your own business, in the beginning, you're probably going to be doing everything yourself. For one, because you need to know how the business works. And number two, you got to keep that cash in your business, because keeping the cash in your business right now is the most valuable thing. But as you grow, you got to start valuing your time and know when it's right to pay somebody else to do something for you. Number 6 is don't chase an investment. And this is probably one of the hardest lessons to learn unless you make the mistake yourself. And don't chase an investment means when you see a stock or any asset on the news growing quickly, you get excited and you say, oh, I want to get in too. You might hear of the newest tech companies, the newest AI companies, the newest whatever companies that have been booming. And now you don't want to miss out on the fun. And the common story amongst every time this happens is this stock or whatever asset has gone up by 50%. It's gone up by a lot. And every expert that comes onto the financial news says that there's so much more room for this thing to run. There's so much more upside. This is just the beginning. It's going to get so much better. And then now you get excited and you think, maybe I don't want to come in too late. But then you see the stock go up by another 10% and you say, you know what? yeah, this is it. I want to get in. This is going to go up so much higher. I want to get in. Now you come in and you start buying. And in the short term, you might see your investment go up even more. But then what ends up happening a lot of times is 2 months go by and some bad news comes out. This company says we've been growing a little bit too big, or we need to do layoffs, or demand has started to slow down or cool off a little bit, or technologies are changing, or the company gets sued. All these things happen all the time. And then you see all of a sudden the stock drop by 35%, almost overnight. Now, the people that got in early before all the media hype, they're still up huge. But the people that were chasing, who missed the early opportunity, are now down. And this is where now when you buy with emotions, you're also much more likely to sell. Maybe if you held on, you might see big gains in the next 5 years, maybe 10 years, maybe not. But this is where now understanding why are you buying. If you're just trying to chase a rally, you're probably too late. Now, if you're buying it for the long term, that's a different story. But when you're trying to chase, many times you're going to end up losing. Number 7, one person's pain is another person's opportunity. And I'm going to be very blunt with this because this is the reality of how our economic system works. When one person has to sell an investment at a huge loss, that means you can come in and buy it at a huge profit opportunity. When the 2008 crash happened, people were getting foreclosed on left and right. Now, it wasn't the investors who told people to go out and buy homes they couldn't afford, to go out and take adjustable rate mortgages, to go out and do subprime mortgages, to tell the bankers to go out and do these sketchy loans, to issue loans, to do all these things. But it happened. And then people were getting foreclosed on. And when people got foreclosed on, the banks got overflooded with foreclosure properties. And then the banks had to start liquidating these foreclosure properties. And then investors were able to come in and buy these investments, these rental properties, these homes for pennies on the dollar. Why? Ultimately, because people made bad decisions. Banks made bad decisions. Bad things happened, which created good opportunities for investors. It happens all the time in multiple asset classes. When you see the stock market fall, well, many times when you see a big crash, that means that people had to oversell off because they had overbought. When people think that nothing can go wrong, they will buy with money that they can't afford to lose, maybe even use debt to buy investments. And then when things go down and they get underwatered, now you can see overselling. And when you see overselling, that creates an even bigger buying opportunity. This is, unfortunately or fortunately, depending on how you look at it, the way that investing works. Somebody has to sell something that somebody is going to buy. And your job as an investor is to be able to buy good investments at a good price. And a good price means, well, if you can buy it at a discount, even better for you. You want to look for the opportunities. And that means number 1, you have to be prepared. Number 2, you have to be financially educated. And then number 3, you have to be willing to take the opportunity when it comes your way, because the reality is somebody else's dumb mistake can be your great opportunity. Number 8 is if it's too good to be true, it probably is. And there's no good way for me to explain this. But you know that feeling that you get in your gut? Everybody talks about this. It's hard to really quantify and qualify what that feeling is. But when it feels like something's off on a deal, it probably is. And trust your gut's instinct on this. If the person seems like everything is too perfect, if the asset seems like everything is just too rosy, everything is too nice, it probably is. And this is where understanding that when people are desperate to sell something, they'll be much more likely to cover up the blemishes. So understand that. If something seems too perfect, too good, use your gut instinct and either do more research or potentially consider walking away, because sometimes those can be either the get-rich-quick schemes that talk about how nothing bad can go wrong, or it could be an investment that's on the verge of imploding. And this is where you got to be able to differentiate the investment that's selling for a huge discount and the investment that someone's just trying to get rid of before the thing implodes. Number 9 is understanding your worst investments, because for most successful investors, their worst investment wasn't something that went down, wasn't something that they lost money on. It was a missed opportunity. It was a great investment opportunity that they didn't take. Now, you don't always know what a good investment opportunity is. Hindsight is 20/20. But that, for pretty much everybody, is going to be their worst investment, is making the lost investment. this is where now looking through your investment opportunities and understanding that sometimes the ones that you can pretty much think are a guaranteed win are the ones that will lose, and the ones that you will never in a million years think will succeed are the ones that win. And the really successful investors are the ones that are able to kind of cut through all the noise, go through all the fancy stuff, and find the real investment opportunity and stick with it for the long term. Now again, hindsight is 20/20. You're never going to know until it happens. But understanding that sometimes the best investments are covered up with the most crap. And finally, number 10 is there will be another once-in-a-lifetime opportunity. And this goes back to not being emotional. Because when you go through now your investment journey and you start finding investment opportunities, you're going to see some opportunities that you feel like are amazing. The stock, I cannot believe how low it's trading. This is going to be a great opportunity. Should I go into debt to buy it? Or maybe it's a real estate deal. This is an amazing property in an area where everything is developing and you cannot believe that this property is for sale. And you feel like this right here is a once-in-a-lifetime opportunity. But if you're not ready to buy it, don't invest on emotion. Because there will be another once-in-a-lifetime opportunity. There is never just one once-in-a-lifetime opportunity, which is why you don't want to get emotional with your investments. If something is not adding up, if the numbers are not making sense, if something is not clear in the deal, don't go in and buy it just because you think that there will never be another opportunity like this again. There will be. There will be another once-in-a-lifetime opportunity. So don't go out and do something that is against your investment goals and your investment strategy just because you think that this is the only time that you're ever going to see a deal like this. Whew, that was a lot. What are some other mindset traits that every successful investor has? Let me know down in the comments below. I knew I wanted to be rich when I was a kid. Not because I was some greedy, money-hungry child, but because I just wanted to buy my dad's time back. My parents are immigrants from a state in India called Punjab. And the way it works is when your parents come from a different country, a poorer country, and then to come to a place like America, now not only